Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of sector-specific ETFs explained, how XLV, XLY, and others can fit your portfolio. In this part we'll look at strategies for choosing sectors, balancing risk, and using ETFs for long-term growth. Let's continue. Strategic sector rotation. Some sectors thrive when others struggle. Tech might lead during low-rate environments, while utilities often hold up in recessions. Sector-specific ETFs let you pivot quickly. No need to buy 20 stocks when you can trade a single fund. Here's how rotation works. Economic cycles. Consumer discretionary, XLY, tends to surge early in recoveries, while healthcare, XLV, shines in downturns. Interest rates. Financial ETFs often rise with rates, while tech may struggle. Policy changes. Clean energy ETFs can jump on new subsidies, while fossil fuels face headwinds. By rotating into stronger sectors, you can adapt to market conditions without overhauling your entire portfolio. ETFs make these moves faster and cheaper than trading individual stocks. Risks and considerations. Sector-specific ETFs like XLV and XLY simplify investing in industries you believe in, but they're not bulletproof. Every strategy has trade-offs, and these funds come with risks tied to their narrow focus. Before loading up on a single sector, it's smart to understand the potential pitfalls. Sector concentration risk. Putting too much of your portfolio into one sector is like relying on a single engine to power a plane. If it sputters, you'll feel the turbulence. Sector ETFs keep you diversified within an industry, but they still expose you to broader sector downturns. For example, a slump in drug pricing could hammer XLV's pharmaceutical holdings. A recession might crush XLY's retail and travel stocks. Unlike broad market ETFs, which spread risk across sectors, these funds rise and fall with their industry's fortunes. That means higher volatility. Sectors can swing harder than the overall market. Timing challenges. Predicting sector performance is tough, even for pros. Recovery risks. Some sectors take years to bounce back after a crash. Think dot-com bust. If you go all in on one sector, make sure you're comfortable with the ups and downs. Pairing it with other sectors can soften the blows. Economic and regulatory factors. Sectors don't operate in a vacuum. Changes in the economy or new regulations can reshape an industry overnight, and your ETF's value along with it. Economic shifts matter. Consumer discretionary stocks, XLY, thrive when jobs are plentiful but often sink in recessions. Healthcare, XLV, is more stable but can still wobble if Medicare cuts drug reimbursements. Policy changes add another layer of risk. A crackdown on tech monopolies could slam XLK, tech ETF. Green energy subsidies might boost ICLN, clean energy ETF, while hurting XLE, energy ETF. The lesson. Keep an eye on the bigger picture. Even the strongest sector can stumble if the economy or regulators turn against it. Diversifying across sectors, or using these ETFs as tactical plays rather than core holdings, can help manage these risks. The key is knowing what you own and why. How to choose the right sector-specific ETF. Picking the right sector ETF isn't just about past performance or catchy tickers. It's about matching the fund to your goals, risk tolerance, and market outlook. Whether you're eyeing XLV for healthcare or XLY for consumer trends, a methodical approach helps avoid costly mismatches. Here's how to narrow down your options. Assessing your investment goals. Before buying a sector ETF, ask yourself, what's this money for? Your answer shapes everything. Long-term growth versus short-term plays. XLV's healthcare stability suits retirement accounts, while XLY's cyclical swings might fit a tactical trade. Risk tolerance. Tech ETFs soar and crash faster than utilities. If volatility keeps you up at night, defensive sectors like healthcare or consumer staples may feel safer. Time horizon. Planning to cash out in a year. Be wary of sectors prone to sudden downturns, like energy. Investing for decades. Early-stage sectors, e.g., clean energy, could pay off. Think about how the sector fits your broader portfolio, too. If you already work in tech, loading up on XLK might over-concentrate your risk. Balance matters. Analyzing performance and fees. Not all sector ETFs are created equal. Dig into these details to spot the best fit. Expense ratios, cheap matters. XLV charges 0.09%, but some niche sector ETFs cost 0.50% or more. Over 0.20% eats into returns unless the fund consistently outperforms. Historical returns, with context. Don't just chase last year's winner. Look at 5 to 10-year trends to see how the ETF behaves in different markets. Compare the ETF to its benchmark index. A fund that trails its own index isn't doing its job. Tracking error. This measures how closely the ETF follows its index. A 1% error might not sound bad, but over time, it adds up. Funds with high turnover, e.g., some thematic ETFs, often lag due to trading costs. Liquidity. Check average trading volume. Thinly traded ETFs have wider bid-ask spreads, making buys, sells more expensive. Stick to funds with at least $100 million in assets to avoid closure risk. A little homework here saves you from overpaying for underperformance. The right sector ETF should align with your strategy, not just yesterday's headlines. Sector-specific ETFs like XLV and XLY offer a clean way to invest in industries you believe in without gambling on individual stocks. They provide instant diversification within a sector, lower costs than active funds, and the flexibility to adapt to market trends. But they also come with risks, over-concentration, economic sensitivity, and the challenge of timing sector rotations. If you're considering these ETFs, start small. Pair them with broader market funds to balance risk. And remember, no sector stays on top forever. Research matters whether you're tracking healthcare policies or consumer spending shifts. Got a favorite sector or a burning question about these ETFs? Drop it in the comments. We'd love to hear your take. Or, if you're unsure, a quick chat with a financial advisor can help tailor these tools to your portfolio. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.